Hello and welcome to our 8-part video series on types of businesses in India. In this series, we help startup owners and entrepreneurs dissect business structures like sole proprietorships, partnership firms, limited liability partnerships, and companies on various parameters like legal framework, ownership and management control, owner's liability, taxation, and so on. Building on this information, we will now explain the capital structure and availability for these structures to give a clearer picture of their suitability for your startup. So let's begin.
Why is capital important for startups? Capital is the fuel on which a startup operates, grows, and aspires to become big. It is required at every stage of the business. During the early stages, adequate funding drives product development, market research, and initial compliance. With sufficient capital at later stages, startups can hire talent, invest in technology, and scale operations to meet the increasing demand. Access to adequate capital enhances the credibility of businesses, making it easier to attract investors, secure collaborations, and negotiate favorable terms. Let's look at the ways different types of businesses raise capital in this context.
A sole proprietorship. Accessing capital from external resources can be challenging for sole proprietorships since its structure allows only one investor at the helm. The fundraising options available here are personal credit, family loans, and microfinance loans in the proprietor's name. Even though these options are readily available, accessing funds through them can be quite difficult. This is because proprietorships are small businesses with low growth potential, and their credibility is compromised due to high-risk factors of unlimited liability. The biggest drawback is the lack of equity financing due to the prohibition over issuance of shares. So, sole proprietorships can access limited capital and are mostly dependent on personal savings to run the business.
Partnership firms and LLPs. Partners are the primary source of funding in a partnership structure, be it an LLP or a firm. If you consider debt financing, these structures receive funding only when partners provide personal guarantee and agree to pay off the dues regardless of what they're liable for. On the other hand, if you consider equity financing, the only source of funding is the partner's capital contribution. The percentage of contribution is agreed and documented in the partnership deed. Even though this capital limit can be raised anytime, the source of funding itself is limited.
Companies. In terms of access to funding, the most favorable structures for startups are companies. First up, they're credible and transparent institutions, hence more reliable for investment. Secondly, they have huge growth potential promising greater returns. The third crucial factor is the easy transferability of shares, providing a smooth exit option if things do not work out. Both debt financing and equity financing options are robust here. Banks and financial institutions find it easy to grant credit to a company, as its financial records are transparently maintained. Moreover, there is a separation between the business accounts and owner's personal accounts, which helps avoid confusion and fix accountability. Additionally, owners enjoy limited liability protection, so there's no need to provide personal guarantee to loans. Isn't this a win-win situation? Coming to a company's main source of funding, equity instruments. Companies raise substantial amounts of funds by issuing shares to the investors as well as the general public. These include venture capitalists and angel investors as well. We discussed earlier that these shares promise guaranteed returns for as long as they are held, and are easily transferable under adverse circumstances. This makes equity financing a preferable option compared to other sources. Before ending our discussion, let's understand a third source of funding for startups, which is same for all types regardless of the business structure.
Government grants. The government often provides loans and grants to businesses, especially if they belong to priority sectors like technology, green energy, and public welfare. These grants and loans are accessible through various schemes and initiatives for small businesses and startups. We help businesses acquire government funding under major schemes like Startup India, MSME, and more. For details, consult our startup advisors now. And that's the end of this video. Hopefully, with all the information you've received here, you can now make an informed choice as to which structural option best suits your funding needs. If you still have doubts, post them in the comments section or contact us using the details in the description. Found this video helpful? Hit the like button, share, and subscribe to our channel for more informative content ahead. Hit the notification bell and be the first one to know about our new videos. Thanks for watching.